The S&P 500 is well on its way towards a correction and is currently down over 5% in the past month. This on the back of the news that the US will be levelling 25% tariffs against Mexico and Canada and a 10% increase to tariffs on China. This is all combined with week's jobs data that has led to lots of uncertainty and fear around markets and resulted in some stocks involved in the sell-off to be dramatically more than the market. Today I'll be discussing 3 stocks in particular that are excellent quality and trading at a discount during these times, with a bonus 2 stocks that I just couldn't resist adding in. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. The first stock on the list is one that I'm sure if you watch this channel a bit, you're very familiar with. I could talk about it quite a bit. I've mentioned its price to operating cash flow more times than probably any other stock. So I would be remiss if I didn't mention it now, but I'm going to have to, and it's actually now trading for a steep discount with all the sell-offs we've been seeing during this tumultuous time. So Amazon, my largest holding, is currently trading around about $202 per share and is down around 14, going towards 15% in just the last month. And this isn't due to any particular fundamentals with the business. Nothing's gone wrong. There hasn't been a disappointing earnings report. We're just getting a very turbulent time in the markets where people are selling out of this position because they believe tariffs will affect this business quite badly. The reason I don't share this view that tariffs will be the end of Amazon is because of this chart. Here we have Amazon's revenue over the past, say, 13 years. Now, we haven't got the most recent 2 years, 2024 and 2025, but this is the product sales versus service sales as a percentage of Amazon's revenue. And from 2014 to 2023, we're seeing a very obvious trend. The product part of the business, the e-commerce side of the business, is becoming less and less part of Amazon's revenue streams. And the service part of Amazon, the likes of AWS, advertisement, and Amazon Prime, are all becoming bigger parts of Amazon's revenue stream. This is their top line sales. This doesn't even talk about profitability. However, the service part of the business is highly profitable and highly margined, and this has led to Amazon to begin to produce record amounts of operating and free cash flow. But bringing this all back to valuation, my main reason and thesis around this current valuation being cheap is this metric right here. Here we have Amazon's price to operating cash flow. This is one of the most important metrics for Amazon. This has closely followed the share price over a long extended period of time. Here we have the 10-year average for price to operating cash flow. And as we can see here, it's fluctuated considerably, but now it sits at 18.75 times price to operating cash flow. So 18 or so years before you're getting your money back in operating cash flows for this share price. And just down here we can see the average over the past 10 years, which has sat closer to 26 times. So the average over the past 10 years is a lot higher than the current price to operating cash flow, which is very good for this current share price and I believe signals considerable undervaluation. Their price to operating cash flow looks good, around 18 times, and the reason I say that is because of the amount they are expected to grow in the next 3 years. If we look at this chart here, it only shows free cash flow estimated growth. I couldn't find operating cash flow, but it is anticipating capital expenditure as well. Now, analyst estimates have the free cash flow growing by over 40% CAGR over the next 3 years with Amazon. And that's with capital expenditure remaining at very high levels, about the same over the next 3 years, with the investing in the likes of AI. But they're expecting a free cash flow amount of 50 billion in 2025, 74 billion in 2026, and 108 billion in 2027. So if they don't increase capital expenditure over the next 3 years, analysts are expecting their free cash flow to grow rapidly, over 40%. And I believe operating cash flow will be around about 20%, which is what is anticipated by analysts as well. So when we consider those metrics, their price to operating cash flow of 18 times looks very good. So bearing this all in mind, we can now use this to try and value how this business is likely to grow into the future and what returns we might expect from buying Amazon now using a DCF calculator. Now we're going to use operating cash flow. That's the historical metric we looked at. They were trading at 18 times price to operating cash flow. And they was expected to grow around 20% over the next 3 years. Now we're going to lower our estimates considerably for estimating into the next 5 years because it is always uncertain. So I'm going to give a 12% metric growth rate, which is very conservative for the next 5 years for Amazon. And I believe they will likely very much beat this target. The shares outstanding I've left as their 5-year average of around 1.29% increase. And they've also traded at a higher price to operating cash flow over the past 5 years, but I am allowing for this to go back up to the average around 23 times price to operating cash flow in 5 years' time. All of that leads us to a share price that is sitting around about $258 in fair value, and a CAGR over the next 5 years of around 15% or 15.6%. from the share price of around $200 now. So to me, I think you are getting a market-beating return with the likes of Amazon if I was buying it now, which I have been doing in my stocks and shares ISA. Now the next stock is one that I've talked about less on this channel, and I've not really covered it massively as I don't own this particular holding, but it's always on my watch list and I am keeping an eye on it. And that one is Booking Holdings. Now, I have to say this one looks very impressive from a fundamental standpoint right now. This particular position, Booking, is doing very well and has been doing well over the past year, but has shown some weakness more recently. It's an excellent compounder that has done well in the long term. Over the past year, it's currently up around 36%, and in the past 3 months, it's actually down around 9%, leading to the fundamentals looking better against the share price. If we look at this on a price to free cash flow chart, historically, we get a bit of a better idea on the fundamentals. So their price to free cash flow currently looks similar to this, around 20 times. So 20 times is around about a 5% free cash flow yield, which is very good for a very compounding and predictable business. But we can argue this one isn't about predictive. It relies on tourism, which can be cyclical, but I do believe that over this chart you can see that even though the free cash flow has grown considerably, the price to free cash flow has remained relatively similar. So it regularly trades around this levels. However, the average over the past 10 years is actually sitting closer to 22 times price to free cash flows, signalling a little bit of undervaluation there. And now we have to consider how quickly this free cash flow number, or the 5% cash flow yield, is growing for this business, because that will maybe result in the share price continuing to rise, remaining at that 5% cash flow yield. So looking at this, we've got their 7.9 billion free cash flow amount that was produced in December 2024 for 2024 in total. And we have a CAGR over the past 3 years of 46%. Now, that's obviously dramatically increased because of this year here, December 2020, which was COVID. But this has been a massive amount of recovery and just evidences how resilient this business is. Now, to me, this number will slow down. We're going to see more towards the 20% to 15% growth rate from here. But I do think this growth rate is achievable and very good for Booking Holdings shareholders. Putting it all together, we have a 20 times price to free cash flow right now, and we have a free cash flow growth rate of around about 10 to 15%, which would be a massive deacceleration from the 46% we've got over the past 3 years. But that's all on the conservative side. That's what we've got right now. If we allow for that 10% growth in free cash flow, which is well achievable for this business over the next 5 years, we allow for a slight buying back of shares. They do quite a bit of it. They bought back around 4.55% CAGR over the past 5 years, which is really impressive and massively increases shareholder value. We're going to allow for only 3% because that's going to have less impact over time as the share price increases. As well as that, we're going to allow for a price ratio that sits closer to the 5-year average of around 22 times. All of this completely achievable for Booking Holdings, gives us a return that is well above the market average from this point. We get a fair value of around $6,229, a CAGR of about 15 to 16% over the next 5 years. And that's with the share price currently sitting at $4,700. So to me, this one could deliver market-beating returns as well if it can meet these basic fundamentals. So I did promise 2 bonus stocks, and I can't get away without mentioning them before I talk about the last stock pick that I've chosen for this video. In this particular case, we have Brookfield Corporation. This is my second largest holding and one that I've been considerably adding to in the past couple of days because it is doing very poorly or well, depending on whichever way you look at it. It's down about 10% for the past month, and I don't think this is reflective of the fundamentals at all. I think people are concerned around the tariffs, especially around the relationship between the US and Canada, and this all has massive influence on Brookfield's share price. People see Brookfield as this Canadian company that is having to do business with the US, and this is going to dramatically affect their bottom line through tariffs. I don't think that Brookfield are going to be as affected as what people believe. It's an asset management based business and insurance based business. Both operate worldwide. They don't really have much interaction with tariffs, but I could be wrong. So that's my perspective. That is one of the particular stocks that I've been buying into. The other one is Google. Now, I just love this share price at the moment. I think it's really good. It's down to around by about 14% in the past month, and I love it. So I'm buying well around these levels. It's massively returned to the levels that I bought at around this sort of point, and I still believe this stock is massively undervalued. Its price to earnings is currently trading around about 19 times, which is just mental, with the share price sitting at these sorts of levels. So I think Google is one that's going to massively do well from this point, and I'm still buying the stock. My last pick is one that has been undervalued for a while. It's still undervalued, and I still am adding to this position when I can. So this is a holding that is still sitting around my cost per share, and I really like the look of. It's one of the best monopolies in the world, and I don't think it's really going to be affected massively by tariffs. ASML hasn't really performed so far for me. It's down by around about 3%, but I actually quite like it at these levels, around the $700 mark. And I'm going to be explaining why today. After 3 months, it hasn't really moved. Over the year, it's down 27%. And I think this is a good buying opportunity still that people are overlooking. ASML is one of those great companies that always trades for lofty valuations due to the monopoly that they have in the machines that manufacture chips. However, as of right now, they trade for 28 times price to forward price to earnings, whilst their median in the past has been 33 times, which signals slight undervaluation to me. Additionally, we have the news that Taiwanese chip-making giant TSMC is going to invest $100 billion in the US. Now, this is going to massively affect the likes of ASML. TSMC, along with Samsung and Intel, are the biggest customers for ASML. And this investment means that the likes of $100 billion is being put into building out so far 3 plants in Arizona after the Biden administration offered billions in subsidies. This sort of level of investment is very good for ASML because they have to furnish these plants with the chip manufacturing equipment from ASML. So I could see this being a huge beneficiary for ASML in the future. Talk a bit about ASML's valuation. We've looked at its forward price to earnings and it looks undervalued based off that metric. But this is a post on X from Conchel Capital, which did a great summary of the thesis behind Valley Forge Capital investing in ASML. And Valley Forge Capital is a great investment firm that's the likes of Dev Cantasario, which is one of the best investors in the world. And he talks all about the AI beneficiary part of ASML, and he talks also about their technological dominance and how they're an established monopoly. But restricting all of that, we just look at the compelling valuation. They said at around $800 per share in September 2024, the ASML was trading at around about 4.5% free cash flow yield. And with the high teens to low 20% annual growth projected over the next decade. So in their mind, the free cash flows are suppressed right now, and they still were back then. And they think that this results in around a 4.5% free cash flow yield. I don't think I necessarily agree with those sort of figures, but I do believe that even now it's trading at a better price. It's trading closer to $700. So I think this particular valuation for ASML still looks very attractive, and that's why I've continued to buy into this particular holding. But that's about it, guys. That's bit more like 5 stocks rather than 3, but those are the positions that I'm continuing to add to. I really like the prices of, and I hope you do too. If you like this video, then please consider leaving it a like. It really helps me out. But thanks for watching. I appreciate it, and I'll catch you in the next one.